The media industry has been on a roller coaster ride this year. Remember, the advertising market had already weakened well before economic worries took hold in other sectors. Meanwhile, strikes in Hollywood further complicated matters for studios, and here in Canada, traditional broadcasters have sought a more level playing field with American streaming giants. As they navigate that, there is an ongoing battle with tech giants like Meta and Google's parent Alphabet on the subject of being paid their fair share for content posted online. All of this influenced the latest quarterly results from Canada's Corus Entertainment. The company's revenue and adjusted earnings top Bay Street estimates, but the results still reflect lingering challenges, and the company is suspending its dividend to ensure money coming in goes towards things like debt payments. Doug Murphy is the president and CEO of Corus, and he joins us here in studio. Doug, thanks for the time this morning. Appreciate it.
Thank you, John.
Let's just start with the dividend. When did you determine this was the kind of move you might have to make?
Well, it's a board decision, and so we proactively and prudently amended our credit agreement and decided to redirect our capital allocation strategies more towards funding the organic investments in the business and more of a real focus on paying down the bank debt. So the environment is so uncertain. I described it as distortions out there. So if I could just go down that path, so we're seeing what I've described as macroeconomic distortions. These are all still, in our view, pandemic-related sort of adjustments. So, you know, there's labor inflation, which is costing packaged goods companies to have to raise prices or manage margins. Some are investing more in the category to take advantage of other competitors who are investing less because they have less inventory. For example, advertising strategies differ by competitor in categories. We have consumers that used to buy TV sets and furniture and renovations. They're not doing that anymore. Those categories are all down. They're going out to services now with entertainment and concerts, Taylor Swift, and dining out and travel. And then those are the macroeconomic distortions. And then you've got industry distortions. In the last 18, 24 months, all the streamers that launched during the pandemic, Disney Plus, Discovery Plus, even Netflix now are adding an ad layer. So they're bringing more advertising into their business models, which is increasing a whole bunch of inventory on the digital video side when there's not really the demand in the market. So there's a bit of a disequilibrium. So all those factors, there's so much uncertainty that the prudent decision was to, just refocus on investing in our core strategies, which you can talk about, and really looking at getting that bank debt lower. Well,
and we should be clear that while you are a traditional broadcaster, you have a longer-term plan to be somewhat agnostic on where content is consumed, and so it's an evolving process. But I guess in the short term, there's still what's happening with the ad market. And the one thing I noted in some of your complimentary material with your results is that as we look into next year, like we talked about the strike action, that you have, I guess, the challenge of new product to put on air to influence ratings and the advertising environment. Because the ad slump, you've said it many times before, started a while ago. But this strike has kind of this lingering effect on that front?
Absolutely. So that was, these distortions I spoke of, macro and industry, were separate and apart from the writer's strike. So all of a sudden, the writer's strike, completely sort of upended our audience delivery. So that's our inventory. The same with your parent company, Bell Media. So our outlook is, we revised it to say we're looking at 15 to 20% declines in revenues for advertising because we simply can't drive the audiences because we don't have the scripted content coming in from Hollywood.
So you've got a number of things you have to consider in that environment. You talked about the dividend suspension. We'd seen headlines recently about conversations between your organization and the CRTC with respect to the requirements on spending, Canadian content spending. Can you just walk us through how that all played out?
We made an application in November for interim relief on our spending obligations. We all have obligations to spend. The CRTC issued a statement on October 11th saying that they were inclined to approve what we had asked for, which would give us much more flexibility. And it's important, John, because when you have, I said it was a double whammy, when your revenues are down like they are for us, like we're down 10, 11%, on the year and the quarter, and you're Canadian spending is going up. That's the wrong math for margins, right? So what we're trying to do is basically have more flexibility so we can do better planning on our content and make the shows that work. Like we have a lot of lifestyle channels, so I'm not going to promote our shows on your air, but we like Rock Solid Builds, Island of Bryan. Those are shows that work. Long dramas don't really work, and so now we have more flexibility. And that we're encouraged. You know, it's the most substantive regulatory change we've seen from the CRTC in a very long time, and we're encouraged by it.
I think there's a broader question about where this industry goes, and yes, you're right. I'm in the media industry here. We're always curious about it, but at a time when you have American streamers that came into the market, you made that point of Netflix now adding the advertising component. There are these regulations around the creation of Canadian content, and that is a good thing that we can obviously support our industry, but there's constantly squabbling happening. And the other thing, I mean, I alluded to it in our introduction, this Online News Act, and we're still seeking clarity on how that's all going to unfold. How do you think that part of the story is going to play out?
Well, I think we have made the right decisions from a legislative perspective. Bill C-11 and Bill C-18 are much needed for different reasons, but they all come together.
Both of those issues.
They're both, Bill C-18 in and of itself is a challenge right now for the government. We're fully supportive of the ambition behind it, and that is to value what news is. I mean, I can't tell you how much mis and disinformation is out there. You know this better than I. You're the business news fellow. So news like CTV News or global news, we are very important parts of society. And what Bill C-18 tries to get at is better compensation for news providers, and we're 100% supportive of that.
Okay. With the stock right now below $1 per share, I mean, you talked about the board decision on the dividend. Most of the analysts, generally speaking, as things were uncertain for the business, felt that the stock was, or the company was worth more than the market was valuing it at. I would assume you feel the same way right now. But how do you approach this environment? You've got this long-term plan. There's these short-term headwinds. So how do you navigate through that?
Well, that's a great question. And so a couple of things. First of all, our strategy is to be video first. So we're basically we're moving from beyond being a television broadcaster to being an aggregator of premium video across all platforms.
Which you do, because we got Amazon in the headlines today. You've got this example. You work pretty closely. Stack
TV, which is 700,000 subs on Stack. So we have, I think, 13% of our revenues now come from digital platforms. That's been growing meaningfully, and we want to grow that a lot bigger. On the flip side is that we have a program to really look at our cost structure, and we said on the call today, and these are difficult choices, but we've been basically reducing our head count, taking out costs across the business. We sold a non-core asset, Toon Boom.
That was one of the considerations for the quarter.
For $141 million to pay down our bank debt.
Would you need to consider more actions like that?
Potentially. We're always looking at our non-core assets. So basically, we're looking at rationalizing our asset base and streamlining our operations, and that's what we're calling Fit for the Future. So we have two different kind of handles: video first, Fit for the Future. So we just have to stay focused on execution. And our view is on the writer's strike, for example. The opinion of many, and we would hold this, is that we should have resolution, we hope, by U.S. Thanksgiving. And the writer rooms are already open now because the writers came back to work. So the writers are furiously writing scripts like crazy. And all the big studios, streamers alike, are ready to get back into production as soon as we can get SAG and AFTRA and the studios aligned. And I'm supportive of having a fair third way outcome there. But we're of the view that we'll get our full schedule back for the third quarter, which is kind of March. And that's our second highest revenue quarter. So that's what we're pointing at right now. We're just battening down the hatches, running the business, and hoping to launch a full schedule in the spring.
Okay, Doug.